Would you please let me know in the Q&A box if you can hear me and see our speakers? Thank you. That's great to know. I'm Terry Cohan Link, principal of LINKCO. Greetings, good morning, good afternoon, good evening for those of you joining us from other sections of North America and around the globe. I'm excited to welcome you and thank you for attending the webinar ESG Investing, Move the Needle and Avoid Greenwashing. I will introduce our speakers in a few moments. The Resilient Realism webinar series developed out of insights shared by business leaders, such as yourselves, about the current and dynamically shifting business climate during recovery from COVID-19. The conversations resulted in a white paper entitled Resilient Realism. This is LINKCO's way of giving back and sharing relevant information we learned speaking with business leaders on a day-to-day basis as part of our ongoing executive search practice. The summary of the white paper is on the LINKCO website. In the wake of COVID-19, many of the respondents have been grappling with changing business realities, economics related to their assets, products, services, remote and hybrid workforces, and changing workspace demands and expectations, particularly now during the recovery phase from COVID-19. How to evaluate types of risk, work product, best remote practices to safely protect assets and clients, evolving cybersecurity and privacy challenges from offsite locations, environmental impacts of the pandemic, to note but a few of the insights, disruptors, and challenges discussed in the white paper and the webinars to date. Today's webinar focuses on ESG, environmental, social, and governance investing, and avoiding greenwashing. Recently, there have been major macro shifts towards ESG investing. Morningstar estimates that global sustainable fund assets have almost doubled in the past 6 months to over 3.9 trillion. We will continue from previous webinars unpacking the confusion about terms, the dynamically shifting expectations from clients, suppliers, and the public, touch on SEC reporting requirements, address your questions, and take a deeper dive into understanding ESG portfolios, corporate ESG solutions, SDGs, those are the UN Sustainable Development Goals. Stay tuned for additional webinars on this topic, as this is a rapidly changing environment and we anticipate evolving federal announcements, which will be highly relevant to our conversation. You'll be able to find links to all future webinars on the LINKCO website. A little housekeeping. Some of you have kindly shared your questions beforehand, and those have been integrated into the webinar's Q&A format. You may also send questions and comments in the Q&A box, and we'll try to address them during the webinar. Now let me introduce our speakers. Chris Knapp, Managing Director, Principal, Robertson Stephens, has over 36 years experience as an investment advisor and entrepreneur. He began his career at Brown Brothers Harriman in New York, later co-founding and serving as CEO for Chilton Capital Management in Houston. Prior to joining Robertson Stephens, Chris founded and served as CEO for Collaboration Capital, an investment advisory practice predicated on ESG principles and the power of for-profit enterprise to solve for complex growing problems. He's a stalwart believer in the importance of active community engagement and civic leadership on the part of corporate citizens, and he serves on many boards and in leadership capacity with many organizations throughout the communities that he is connected to. Chris earned a BA in art history and history from Williams College. Bill Page is a senior portfolio manager at Essex Investment Management based in Boston, Massachusetts. Bill has been focused on ESG investing for 30 years, having started with an internship at KLD Research during business school, one of the first SRI research firms. After posts at Fidelity, Wellington, and State Street Global Advisors, where he was global head of ESG, Bill moved his thematic investment strategy to Essex in 2009, relaunching the Global Environmental Opportunities Strategy, GEOS. GEOS is the first thematic listed equity impact strategy in the US. Essex launched a mutual fund version of GEOS in 2017. Bill majored in economics at Boston University and received his MBA from Babson College with a concentration in finance. He is active at colleges and in universities on the ESG circuit, speaking on clean tech, investing, thematic investing, and moving the needle on climate solutions. He's an early adopter of all things clean tech oriented and enjoys cycling, alpine skiing with his family, and getting on the water on his paddle boat. Bill and his wife, Wendy, frequently hit the trails of Western Maine and Concord, Massachusetts with their corgi, Peter. Now we're going to start the conversation. Just give me a minute to change over to allow Chris to forward our slides. And then I'll ask our first question. Okay, Chris, you should have control and you should be able to turn over to the PowerPoint.
Let's see, Terry, let's see, let me share material, and there we go.
Okay.
There we are.
Thank you. Here's my first question. Would you each take a few moments to explain why you're focused on ESG investing and what's important to you both in this regard?
Absolutely. Terry, I'll jump in. And first of all, thank you for the beautiful introduction. If I hadn't written it myself, I'd say I wish half of it were true. But Bill has heard me say this maybe perhaps too many times, but I grew up in a house where my mother took away both the television and processed foods when I was in third grade. And on top of that, just so the audience knows, if nothing I say makes sense, it's because I'm left-handed and also an identical twin. So at least you'll have some semblance of understanding. But as a result of all of that, my mother was really a pioneer in thinking about food and food systems. This was 1970, and essentially banned preservatives from our house, and another topic which relates to ESG. But I was also lucky that I grew up in a family where my parents got married very young. And as a result, I was lucky to know so many of my senior family members. I knew 4 of my great-grandparents. My last great-grandmother died when I was 17, and these were 19th century people. And for those in the audience for whom ESG or impact or social entrepreneurship are new terms, it's easy when you read a lot about this to assume that this is some new sort of fad or some trend. These are based on principles that I learned from my 19th century great-grandparents. So what's old is in many ways new again. But I got particularly interested in where we are today in terms of the opportunity for capital markets, because I also grew up in a family where both of my parents' families had operating companies that were family owned. And in my father's field and my grandfather, his father, they were what we would now call community bankers. And as a kid, I was hauled around to really the borrowers of this particular bank and institution, which were, in today's terms, we would call them SMEs, a small to medium-sized enterprise. These are SME defined as an entity that employs between, say, 5 and 500 people. And what's interesting in a world where everything seems so gigantic, the Amazons and the Googles of the world, SMEs, or what you might think of as family-owned or mom-and-pop businesses, still represent about 2/3 of global GDP. So the power of, and in community banking specifically, which really doesn't exist anymore, unfortunately, my father and grandfather were really in the business of making what we would think of as character assessments of the borrowers. This is pre-FICO scores, and really there was no technology. An enormous prosperity was created across the United States in towns and cities because of access to credit. So I'll pause there and I'll dig into some of these theses a little bit later. But I'm particularly passionate about what the power of money, specifically what I call personal capital, can do to affect the change that so many of us want to see in the world and are otherwise engaged in it either philanthropically or through policy change. And I'll make an argument as we get into the conversation that money and capital markets are the most powerful tool left in the toolbox for us to affect that. And that's how I met Bill Page, my colleague here and visionary. And I'll turn it over to Bill.
Thank you, Chris. And Terry, thank you for all your efforts. I love your definition of resilient realism. I think it's perfect. Perfect for what Chris and I are talking about today. And Chris, it's a pleasure to be presenting with you, my longtime cohort and collaborator and impact for now over a decade. And so, Terry, I think my bio sort of covered a lot of it. My vision and travels in SRI, ESG, impact. We don't want to get into the definitions, purely focused. I have been on moving my desires around environmental solutions into the capital markets. And that's why I chose to do this, much like Chris. And Chris, by the way, there's a saying that if everyone's born right-handed, only the gifted can move to the left-handed. But
I like that one. I'll go with it.
Yeah. So, but in my background, my parents were active environmentalists. I grew up north of Boston, and I wasn't able to go to baseball camp. I was forced to go to nature camp, but I actually really enjoyed it. And in the late 70s, sort of an early student of Rachel Carlson and Silent Spring. And I've always been outdoors, always been focused on the outdoors, and I tried to bring my personal interest into my investment practice. And so, as you said in my bio, I've been doing ESG investing for now over 30 years, and that was sort of haunted and a result of what I did in business school, working as an intern for a year and a half at KLD, which is the precursor of an aggregator of ESG data now owned by MSCI. But back in the day, it was really one of the first social research firms. And so that experience in business school, wherever I went, whether it was Wellington, Fidelity, or State Street, I was focused on ESG, some sort of ESG. And I sort of lived the whole transformation from negative screening to best of class investing, and then now focus on solutions. And the reason why I wanted to focus on solution-oriented investing and investing in companies that are providing solutions to climate and other ancillary social and governance and environmental problems is that it's a massive, I believe, a massive investment opportunity. And so as you think about most of the effort around ESG since it was invented actually in the U.S. formerly in the mid-1950s, has been around staying away from companies that are doing bad things or screening out or values alignment, and all really, really valid attempts. But what I want to do is really, as I say in my bio, move the needle to investing in the solutions. And we'll get more into why we're doing that now. But I think the time is nigh, and the time is great to be focused on solution-oriented investing. The other thing that I learned during COVID is the overlap between environmental challenge globally and social challenges are getting more important than ever. And we can solve for that. You can solve for social progress when you solve for environmental progress.
Let me continue with our questions. Based on Morningstar, global sustainable fund assets have almost doubled in the past 6 months to 3.9 trillion plus, and by their definition, there are almost 7,500 sustainable funds. Would you start us off by briefly explaining how both Robertson Stephens and Essex GEOS approach ESG investing and why, and what's different about what you do and your approach?
Of course, I'll dive in initially just to speak sort of an overarching framework around portfolio construction. So when anything gets big or popular, there's often a lot of garbage that comes in. So for us, the emphasis has always been on the power and the importance of critical thinking. Anyone who's familiar with ESG investing may know that just about every entity that you can access on the web, it could be Yahoo Finance, it could be Bloomberg, it could be MSCI, a number of other data providers, have an often formulaic score system for any one company's ESG rating. And none of that applies to the kind of work that we're doing at Robertson Stephens in terms of portfolio construction. Everything is based on what we think of as the sound principles of just good investing, which is not only critical thought, but it's what the industry calls fundamental securities analysis. So what we do is different, is how we think about the power of what I call what's under the hood. And going back to my own personal training, both in my own family and professionally at Brown Brothers that Terry mentioned, so much of my training came out of Depression era, World War II, and Greatest Generation mindsets, which was just an extraordinary gift because this was a time when there was essentially no technology, or certainly not technology as we know it. And so much of the training was really an emphasis on no shortcuts, taking the long view, which I think is critically important for thinking about where we are in the world specifically today. And also, as I mentioned a few moments ago, what's under the hood? What is the integrity of the process? What is the critical thought that goes into this? And how do we actually think about it? So at Robertson Stephens, our goal is actually to build portfolios for, specifically in my role in terms of leading the ESG practices, how do we think holistically about portfolio construction predicated on those principles that I just described? And Bill, I'll turn it over to you because you are a great example of what I call a puzzle piece within a portfolio in terms of how we think about strategy and strategy implementation and the process and the discipline behind that.
Great, thanks, Chris. So I work at what's known as a boutique. So it's a smaller investment firm. We run about $900 million in assets. We are based in 2 locations, Evanston, Illinois, and Boston. And Essex is a growth equity boutique. So we invest in listed equities or stocks. But we focus on thematic investing. So we invest as a firm in disruptive growth. So that disruptive growth, I'm focused on clean tech. And Terry, I recognize you asked about ESG, but we really start with solutions as a firm. What are the solutions? And we believe strongly in secular trends. So when you find a solution, you're solving for a solution as a company, we believe that's a recipe for strong, long-tailed, dynamic returns. And so that's the starting point on how we operate as a firm. We've completely integrated ESG frameworks and metrics into our process, and we'll be explaining that throughout the presentation. But to us, ESG metrics and frameworks help us formulate information and more information as we research a firm. That's all ESG is. To me, it's more information, which will lead to a better bottom line. What we're doing with GEOS is one step beyond that and inclusive of that. So GEOS, the Essex Global Environmental Opportunity Strategy that I manage with my co-manager, Rob Ewick, we're focused on solutions in the clean tech arena. So solving for climate, solving for these long-term secular trends. And we believe that the best way to solve for solutions is what's known as thematic investing. So I define thematic as investing for secular change, solving for things like urbanization, population density, secular shifts in the emerging markets, the energy equation. And so Chris is showing a page here which describes the 9 themes that we are solving for with GEOS. And so these themes solve climate, but also importantly solve other environmental and social problems, like, for instance, urban density, ambient air quality, the need to go out. We need to go out and harness about another half an Earth of resources somehow in the next decade plus, given all these secular changes. And so we believe the best way to do that is through clean technology, which solves this flight to sustainability.
And Terry, I'll just add to Bill's comments because I think it's a great context for what I described at the outset in terms of the importance of critical thinking. So neither of us in this practice, and both of us have been doing this for a bit, are formulaic in our thinking. It's about, again, the guts of what's inside. And just for clarity for the audience, for those of you who aren't familiar with either Essex or Robertson Stephens and how we play different roles, Robertson Stephens is a national wealth advisory practice currently managing about $3.5 billion for individuals and families. My specific role within Robertson Stephens, which does a lot of different things across financial assets, is specific to my own expertise and career experience in ESG. So for what I call forward-looking individuals and families who are interested in ESG, my job is to think holistically about what a portfolio looks like across stocks, bonds, cash, alternatives, et cetera, that meet these ESG criteria that we're touching on today. Bill is an example of an ingredient or a menu item that might be included inside of that portfolio. So for clients who are specifically interested in climate and solutions of capital markets to solve for ever-growing issues specific to climate, water, energy efficiency, Bill and the strategy he's describing is a great example.
Okay. Thank you. Thank you both. And that's a good segue. What do we need to know to start ESG investing? What are examples of companies that impress you both and why?
So I'll start again, and we'll change the order in a little bit. But since my role is sort of thinking more holistically about portfolio construction and what I call overarching context of this discussion, I think the most important thing for an audience like this to know is how powerful your investments can be in making the world you really want to be living in. I'm constantly, frankly, a bit stunned by how many people who are so extraordinarily well informed and doing amazing things philanthropically and also working diligently towards policy change to affect the change they want to see in multiple areas of common passion, have no idea what they're actually invested in their investment portfolio. And, you know, it's understandable to some degree because for certain people, finance is opaque and, gosh, it's confusing and overwhelming. And obviously, everything depends on the underscoring the importance of financial security. So too many people I see often say, oh, you know, I just gave money to my advisor and said, keep me safe, and which is an understandable and a critical priority. But in the meantime, often they lose the opportunity to use for-profit investment to align everything that they're doing, either policy or philanthropically, with really, frankly, their most powerful tool, which is their investment portfolio and certainly their consumer spending habits. And why this matters to me, and to be clear, everything that I'm driven by in my particular role, certainly at Robertson Stephens and historically, is driven by macro reality. It's not driven by, gosh, wouldn't it be nice if, or could we wave a wand and make it all better somehow, or let me feel better about my money. That's often the disparaging remarks that ESG or impact investing might get is, oh gosh, that sounds great, but it's not really doable. I believe otherwise. I believe, and particularly in the last decade or so, statistically, the opportunity, often technologically driven, to affect change from immensely profitable enterprises to solve for these issues is here. But just very quickly, a lot of people may not know that global philanthropy, which is fantastic, and all of us probably live in communities where we have wonderful examples of that. But global philanthropy represents roughly 1% of global wealth. So if you just, again, step back from just a pure fiduciary or a macro reality and to pretend that 1 penny of every investment dollar, as great as philanthropy is, has a chance of solving for the complexity and ever-growing issues that we're all confronted with, COVID not the least of which most recently, is fiduciarily, I believe, unrealistic and irresponsible. So I like to call it know the power of your personal capital and dig in deeper and take a look in to see what's here. So with that, I'll turn it over to Bill to give a few specific and perhaps industry examples. And I think that for SEC compliance, we can't mention specific companies because we appear to be making recommendations, but we can talk about technologies and the sorts of things that we see in terms of an opportunity set.
So,
and
go ahead, Terry.
And Bill, as you answer, please, Chris, take a look at the Q&A because there's a question from Nick that I want you to see how you might want to work that in. And Raj Paul's asking, is there a size requirement for investors to GEOS?
Yeah, so what I'd like to do is per our compliance, the answer is we have vehicles for individual investors. And so and we thank you for your interest. So if you reach out to me individually through Terry, I can provide you with an answer to that, but thank you. So Chris, I love the response to your question, to Terry's question, because Chris and I have the same response, but we're coming at it from different angles, and we didn't prepare our responses. We prepared our responses, but didn't share them. So my answer is know what you own also. Know the companies in your portfolio, whether they're in your IRA, your 401k, your pension plan, whether you're an asset owner and you have your own, you're initiating a defined benefit plan, know what you own. It can have an enormous impact for financial return. It also differentiate you from the market. Investing to me is not just owning a big slug of the market or a big slice of the market. That we sort of over-engineered that. I believe we need to move towards knowing what you own and investing in companies that are changing the world. You know, why would you want to own a big oil company with declining margins, declining returns, decreasing return on invested capital, decreasing dividends, and higher costs and compressed margins. Why would you want to do that when you could own a company in an industry growing, which solar is, we believe, at over 18% compounded annual growth rate for the next decade? Why would you not want to move into the new energy transition? Or if you have exposure to big oil and energy, why would you not want to own a company that's making the transition in harnessing and leveraging their legacy intellectual property on moving electrons and extracting fossil fuel and taking that into the new energy economy in, for example, the form of hydrogen? So we don't own fossil fuel in GEOS. We have several fossil fuel companies at the firm, owned by the firm, but we own what we believe are those extractive E&P companies that are making a significant transition, not only pledging net zero and carbon neutrality, but actually doing it through their actions on moving to the new energy economy. So some of these big oil companies are extremely well positioned because they know how to deploy capital very efficiently. Why wouldn't you want to own a company that's giving exposure to the electricity grid? So our grid, we need to fully electrify our economy within 25 years. So why would you not want to have exposure to a company that's helping provide a more resilient grid, a more sustainable grid, a more connected grid, as we introduce electrons, so sources of electricity that are more digitized? So think about what we did for the iPhone and individual connectivity in language processing and processing in the TMT revolution 18 years ago. So that whole digitization will be eclipsed in the amount of data that will be created as we digitize electrons in the energy transformation in the next 20 years. So why would you not want to have exposure to that? Why would you not want exposure if your children or you or your grandchildren are starting to consume alternative protein? So oat milk and alternative protein is up to 80% less carbon intensive than animal-based protein. So why would you not want exposure to that growing dynamic? So to Chris's earlier point, we're really doing this for the bottom line financial return, the opportunity, but also having the gravy here and having your cake and eating it too is that we're solving for massive changes.
Right.
Terry, I love your prompt. If you don't mind, I'll jump into the question from Nick because I want to add a few things to what Bill just said. And then Nick, thank you. I feel like I could have set that question up myself because so thank you for raising it. I'll mention what it is in just a moment. But just very important for clarity, specific to Bill's points. Massive change, I think we all know, is happening all around us. So much of our mission is thinking about, again, from a fiduciary standpoint, critical thought standpoint, and a risk mitigation and assessment standpoint in terms of understanding all of those fundamental security analysis components. How do we think about portfolios that are designed to meet or exceed traditional benchmark returns that are actually solving for complex, not only opportunities, but problems that we see around us? Nick's question for the audience is specific to the role of family businesses or family-owned businesses or controlled businesses. And Nick, thank you for the question. It happens that another sort of a really important influence on me and my passion for ESG came from the fact that not only coming from family businesses in my own background, but when I was at Brown Brothers, which is another anomaly in terms of a firm, it was the only private bank left in the United States of size until a recent sale to State Street. Is that so much of my early training was working with families that had started businesses across the United States that, because of a number of different factors, interest rates coming down, the advent of the LBO, massive consolidation across multiple industries in the early 1980s, sold those businesses to much larger enterprises than IBM, the Triple M. And so I've had a lot of experience working with multi-generational families and what I call the power, not only of personal capital, but the role of forward-looking families. And Nick's question is specific to how such family-owned businesses might actually move the needle specifically around ESG and ESG principles. And I think it's important to step back for just a minute and think for a moment as we think about families and family businesses of the root of so much wealth in the United States. Most of you in the audience can probably track this back in your own communities. Was actually rooted in family-owned businesses. Somewhere along the way, somebody showed up in Peoria or Houston or somewhere, had an idea, seemingly perhaps a crazy idea, went often to a community bank, borrowed money, and if they were successful, the rest is history. Often those companies and the families behind them defined whole communities. Many of those families were the ones that started the early philanthropic commitments in their own communities, founding many of the nonprofit organizations solving for issues that those families cared about. It wasn't typically large institutions or the government that was really defining those characteristics. So families have an enormous role to play in how we think about ESG and ESG implementation. And if you control a family business, or if you have a role on the board of a large family enterprise, everything we're touching on today, not only in themes and theses of massive industry shifts, but also governance issues, paying a living wage, understanding your supply chain, environmental practices, environmental stewardship. Any one of these individuals and families can have a profound influence on that. And then just lastly, I'll say a bit flippantly perhaps, but a friend of mine in the industry likes to say that in the old days, you didn't mistreat your employees because if you did, your kids got beat up at school the next day. That sounds a bit flippant and superficial, but it's really interesting to think of these family-led enterprises and who are in many respects still the guts of their community, how business has often changed a lot, where that transparency around everything from supply chain to labor practices is coming back into view acutely. And forward-looking families have a critical role to play in terms of thinking about profitable enterprise that's also integrating these principles with the way they run their businesses.
Yeah. Thank you both for your answers. Bill, you touched on this in your previous answer, and perhaps there's just a little bit more play here. How do you compete with other investment strategies that focus on non-ESG investments with carbon generating and intensive industries like oil and gas?
Yes, thank you, Terry. I also see a question from a participant here, and I'm going to weave Paul's question into my answer on the SDGs in a few minutes. So yes, indeed, the way we compete is we do a lot of educating about what we call the case for moving the needle, and so that's how we compete. And so I'm not when you think about moving the needle to the climate transition. There's a massive disconnect globally right now between the aspirational commitments around solving climate and actual action. So over 90% of global GDP is now signed on or stated that they will be net zero within the next 50 years. Some of these commitments, and these are from governments and companies, so public and private sector. So if you think about these aspirational commitments, what I'm calling moving the needle to those commitments is that the solutions to solve much of the net zero commitments, and these commitments have increased. So we had about only 18 months ago, 20% of global GDP participants, they were at 90. That's in 18 months. So that's amazing. So everyone wants to solve it. Greenwashing is in the title of this webinar. So we need to hold those firms and those entities that have said they are going to solve it to action. And so the way we are competing with non-ESG strategies that own oil is really talking about the opportunity set. So we've spent a lot of time over the last decade plus, our track record's now almost 12 plus years, is really focusing on how clean tech is being invested in globally. Because clean technology is a disruptor. So we've seen over 100-fold decreases in cost in these technologies, whether it's battery or LED lighting or solar, over the last decade plus. They're being commercialized. And so they're being commercialized faster than the incentive. So clean tech isn't solely dependent on government incentive. That's a huge myth. So that's a major point. And we also, I think the energy transition is going to transform every economic sector. So we're focused primarily on investing in industrials and technology. So to Chris's earlier point, we're paired with managers who are more diversified, but that's where we see the most solution. But at the same time, as you know, climate and the opportunities around the new energy are disrupting as we speak. I mentioned ag, consumer products, retail, so everything's being disrupted. So we talk about that, educate that, and then really talk about and define thematic investing. So that's how we're competing against that. So Chris is showing, thank you, Chris. This is a slide, I call it the world at night. And this is really what differentiates us relative to our peer group. And our philosophy, we really take from Nelson Rockefeller, which is with massive problems come great opportunities. And so that's what we're focused on. So I could use and talk to this slide for another hour, but it's really important. Ambient light in this slide is an indication of the OECD developed markets. The regions without high ambient light are obviously areas with much higher economic growth where there's significant secular and demographic shifts happening. That's going to drive the need for us to close that gap even faster. Thank you, Chris.
Bill, speak to Paul's question if you don't mind. I think you were going to weave it in.
Yeah,
if not, I can do it as well.
I'm sorry, I'm off the question page, but so we had a question in regard to it's under like a smaller private company that may be able to solve these problems that are on this chart. How would you seek capital? And I think the answer is there's a massive investment gap, and so that gap is being fortified on the direct and smaller company side by in more of Chris's market by families investing. At the same time, there's an enormous amount, Paul, of action on the academic settings around formulating NGOs and profits and asset owner groups around investing for the new energy economy. One of the fastest growing, I believe, one of the best efforts globally is Greentown Labs here in Somerville. So what I would say is reach out to Terry for ideas also. But I would say the best way is to articulate to the marketplace how your value proposition, whether it's a technology, service, or solution, is solving for an SDG, and put it in the SDG solutions framework, and then bring that to market and engage with asset owners, families, in consortiums around climate solutions. And I'm happy to talk to you offline, as well as Chris is happy to, I'm sure, talk to you about that too.
Happy to. And just very briefly, Paul, there's, again, back on the thesis and concept of what I call forward-looking families. One of many missions for me as a career investment advisor is how do we sit at the table with a multi-generational family and manage assets in a way that meet the criteria we're talking about here today without giving someone in the senior generation a stroke. But being equally resonant to the youngest family member at the table who might be well in their 20s or 30s, and the lens from which they're processing both opportunity and life experience might be vastly different. So come to Terry and ask a few more questions, and Bill and I can follow up with you offline.
Okay. We touched on SDGs. How are companies that are in your ESG portfolio implementing sustainable development goals as set forth by the UN? And is this critical to your determinations?
Great. Again, and I'll start and then ask Bill to dig a bit deeper here. But in the role of really portfolio construction, which is what we do at Robertson Stephens. So just to be clear to the audience, we at Robertson Stephens do not actually manage any assets directly. That Bill is an asset manager specific in this core of expertise he's discussing today, is one of many practitioners on what I would call the larger Robertson Stephens menu. And also to be clear, we have a number of clients at Robertson Stephens and who are not specifically interested or directed towards ESG. My specific role within the practice is to expand and what I call turn the volume up in this specific area of opportunity set. So the SDGs, which some of which here are illustrated, are massive. And really the thought process is how do we actually think about nonprofit, for-profit, and public sector capital going to solve for problems that frankly affect every aspect of humanity and frankly our own survival. So within the holistic framework of the ESG practice within Robertson Stephens, these really matter. But what matters most to us is to be working with teams and what I call practitioners who are using critical thought again and macro reality to think about how they individually are addressing the SDGs. And with that, I'll turn it over to Bill to maybe just give a few examples, some of which are illustrated here on this slide.
Yeah, the SDGs, why I'm very excited about them is they're created in 2017. It was the precursor was the Millennial Development Goals developed in the year 2000. And the reason why I'm really enthused with the SDGs is it's a framework. It's a common language that we can use to bring ultimately for our purposes capital to solutions. That's why I believe it's important. And so when you've been using the term moving the needle, but if you think about that 90% of global GDP signed on to net zero, that's all well and good, but how do we get there and how do we scale capital? So it's also, I believe, when you have, and this gets back to Paul's question, when you have companies that are articulating how their businesses are solving for the SDGs, It should ultimately differentiate for investors, potentially companies that have good, strong term solutions to all these issues you saw that we've been talking about, whether it's climate, ambient air quality, PFAS in our water supplies, algal blooms in New Mexico. So these are all issues we need to solve for, getting power to villages in the emerging markets. And so what I love is it isolates, provides a framework around these issues globally. And so our companies that we own in the portfolio weren't totally aware of the SDGs a few years ago. And we've been engaging with our companies to enable them as they develop their sustainability reports, not just talk about what I call input or the behavior of a company. Let's talk about output. So moving out to how you're solving these issues globally, because I think that'll ultimately bring more capital to these companies. We can solve net zero today in most fashion. So we can get there 50% for full decarbonization with renewables and power storage. And so 50% there. The other 50 will be technologies like hydrogen and distributed nuclear. So we're there. So some of these examples. So what we did is we isolated the portfolio, and then we've defined what we're calling output solutions. So we're defining impact, because I believe that you can have just as great, if not a greater impact in the listed market than in the private markets. And so that's the reason why we did this exercise. So a few examples, you get a few of our themes here. So let's talk about efficient transport, electrification. Transport is responsible of the entire transportation sector. On-road transport is close to 80%. So electrification of the car is really important. But when you have smart infrastructure and smart mobility and autonomy, you also get smarter cities. So there's an example active of a company we believe is helping OEMs, auto suppliers, electrify their fleets. And so even just today, VW became more aggressive in their progression to full electrification from the internal combustion engine. So every major OEM in the world has said they will be fully electrified within the next decade. So it's astonishing what that's going to do to the markets, both ex-US and in the US. That's one example. So there's plenty across, but this is all, when we say engagement, we're not trying to turn around a company that's operating poorly. We're trying to get a company that we believe is solving for these SDGs to better articulate how they're doing it, and then we're mapping to those solutions.
And just for clarity again, for the SEC, these are not recommendations, just to be clear to the audience, of individual securities. This is simply, these are examples of enterprises that are, we believe, leading the way, specifically the SDG. And I'll just quickly weave in Nick's question, because he asked about Asia specifically and family-led enterprises in that part of the world around affecting change predicated on these principles we're discussing today. Again, it sounds a bit flippant, but when a family in your community or an individual in your company, in your community, is making a pile of money with an enterprise, people start paying attention. And I'm in Houston and Texas, where what I call money talks. And I see so much of what we see here in ESG and these macro shifts, and frankly, incredibly profitable and market-leading enterprises, as money talking at the higher resonance of money talking, because it's accretive and solving for complex issues. But too often, this conversation has been somewhat ethereal, or somewhat way too conceptual for people to process, so they think very siloed about ESG. Nothing changes that mindset more quickly than tangible connection to enterprises or people that are actually intensely profitable and leading their respective industries. So these are SDG, as Bill mentioned, is a wonderful way to sort of put it into a larger framework around a common vocabulary.
Continuing, thank you. How does the European Banking Authority recent report on ESG risks management and supervision for credit institutions and investment firms proactively inform how you approach your investments and how you advise your clients? And would you offer a few examples? And what types of audits and carbon offsetting do you require for your portfolio companies?
I'll go with just a couple of thoughts, and just to see the dramatic difference. And I'm being a bit simplistic on purpose, just for illustration, but Europe is generally much further ahead in this conversation than the United States, recognizing that enormous sums of capital in the United States have started to adopt to or invest in strategies that meet the criteria we're talking about here. By way of example, I was at a conference a couple of years ago, and I ended up sitting next to a man who was my mother's peer. My mother is senior generation. She happens to be 81. This is a man who was in the leadership role of one of the largest pension funds in the world, based in Holland. And for those of you who follow geography, the Dutch, fascinating history to think that a country the size of a proverbial or a metaphorical postage stamp once dominated the planet. The Dutch are no slouches at making money or thinking pragmatically about solutions. And this man stood up in front of an audience of, frankly, a lot of skeptical people of ESG, and he looked at the room and he said, "We believe in our role of leading and managing this enormous pool of pension assets, that it's our fiduciary responsibility." This is really important. Not our political responsibility, our fiduciary responsibility to be investing in shares of companies that are likely to result in a world that our retirees can survive in 20 years from now. Just think about that for a moment. Fiduciary led. Unfortunately, in our country, too much of the conversation around climate, for example, is politicized. I believe that's a fiduciary breach, and I think it's fiduciarily irresponsible to the reality that we see happening around us. So enormous pools of capital. Europe specifically, obviously, is far more regulated on average than the United States. But to dig deeper into your question, and I'll turn it over to Bill in just a moment, anybody that we're working with in what I call the practitioner space, in other words, people who are contributing to what I call the puzzle pieces of any one portfolio, we want to, again, I'm repetitive here on purpose, but what is the critical thought that is going into how we think about meeting specific criteria, not only around ESG, but what we see either in regulatory patterns outside of the United States, because remember that many of these businesses, if not most of them, are generating a significant percentage of their earnings and revenues and earnings from outside of the United States. So these are effectively global portfolios in many aspects. They're touching on markets that are obviously in Europe and elsewhere. So Bill, you might have a few specific examples on how we think about that.
Yeah, so Terry, I think, good point, Chris. And what's interesting is that because of the transparency, and this is not just due to ESG regulation, it's due to increased transparency in the part of companies in the listed markets as they operate. And I just talked to one company that's exposed to clean tech, but they're in an extractive company. It's all about where you operate, to Chris's point. And so as North American-based investors, if we were to invest in this company, which is involved in materials for batteries, we would be really focused on their supply chain and their operating procedures in the markets in which they operate. And it's really important. It just came out in a meeting. So in the last few weeks, we had a meeting with a major global automotive manufacturer. We've had a meeting with a battery manufacturer, and we've had a meeting with a company that supplies materials to battery manufacturers. And every single company management team emphasized, without our asking, the importance of supply chain transparency, given the rise of concerns around asset owners around ESG issues. So it is going to materially drive, as we fully electrify the automotive fleet. This is a direct quote from the manufacturer. Consumers want to know where the materials came from. So just as we advise you on the stocks you own, consumers are really starting to initiate and vote with their spending habits, and that's purely driving the way these industries are structuring themselves for the coming clean energy transition. It's a really important initiative. And Terry, to your question on the transparency initiative, so the EU, to Chris's earlier point, they are requiring climate risk disclosure for listed equity companies. I think, and we think, these issues will be coming into our shores for North American listed companies in the coming years. So the frameworks and regulations around ESG are important, but much more importantly is the rise of ESG is happening anyway because of increased concern on the part of asset owners, investors, and companies that want to solve all these issues.
Yeah, thank you. Going back to SDGs for just a moment, can corporate ESG solutions and mapping SDGs improve a company's bottom line? And if so, How, and can you offer some examples from your work with clients?
Maybe Bill, speak to that if you don't mind. My answer would be yes. That there's a powerful correlation between understanding what the SDG framework is, and again, these are all based on massive macro shifts, and so companies that are leading the way are often at the forefront of thinking through often technologically enabled solutions for how we actually address these issues. But Bill, if you want to get more specific.
Yeah, I mean, I think a company that has a solution, they're increasingly recognizing that defining that solution to the marketplace is going to help differentiate this company. Full stop. And I didn't even mention the word SDG. So if you have a solution, why not better articulate it to the marketplace? If you're a old school industrial company with a legacy business that could be in, let's call it extractive shale gas, sour gas processing, but maybe you're working on R&D enhancement for carbon capture and sequestration or hydrogen for electrolyzers, why wouldn't you want to deploy capital in that direction, but better articulate that to the market, right? So being cognizant of that transition. And so it's really a framework. And I believe if companies that do that, and they not only articulate it, but they're doing that with their businesses in profitable fashion, that will lead to the bottom line de facto. So beyond that, the SDG mapping is all about proving it's a way to articulate not only the solution set, but the examples to the marketplace. And focusing on this opportunity is so important, and there's not enough focus on opportunity. The bulk of the efforts in the ESG circles over the last 15 years have been around risk, which is really important. But what I'm really focused on is being mindful of the risk, but also being really representative in articulating the massive opportunity that's at hand, we believe.
Yeah. We have about 5-6 more minutes until I want to, kind of wrap up. And we have 4 more questions. So I'm going to try to rip and hope that you will accommodate. How are you ensuring fiduciaries are educated about ESG investing?
I'll take that and just say that, frankly, it's a lot of conversations like this. I mean, so much of our role, I see my role as an investment advisor as being a catalyst or a conduit towards how we think about solving for issues that we all care about, but specifically, how do we solve for them through our investment portfolio? So I'm gonna hone in on many of the similar theses I touched on already. What is the process? What is the discipline? What is the critical thought behind what it is that's happening not only within our framework of ESG, but the practitioners with which we work? How does that meet specific fiduciary standards in terms of risk assessment and risk mitigation? And then, frankly, education, which, as I mentioned earlier, what's very, a single biggest opportunity for me is to see how many people who are otherwise incredibly well-informed aren't having conversations like this. So that would be my initial response, recognizing that we're short on time.
Terry, in the interest of time, we'll go to your next question. Chris nailed it, I think.
Okay, very good. Why and how are the SEC advisories on ESG reporting relevant to your clients and to your portfolio ESG companies?
So just very quickly, again, from a portfolio structure point of view, they're very important. The SEC, I think, is honing in a lot of issues that are touching, Bill mentioned a few moments, the term greenwashing. The common language, so to say, about ESG is still not here yet. So the SDGs provide a common framework for discussion, but measurement and how we actually think about measurement of different ESG criteria is still pretty fragmented. There's been a lot of data aggregation around this. So I think it's very important just because people pay attention to, yes, we're all regulated by the SEC, right? And the governing body. I've been actually very impressed with the sessions that I've been in of the commitment to recognizing all the different areas that we're talking about, both risk and opportunity. So, Bill?
Yeah, so Terry, very relevant question because we're SEC regulated, our industry. And so SEC's, it's all about prudence and alignment, right? And so it's all about taking best care and best practices of your clients' assets to which we're entrusted to manage. And so that's in the operating principles of Essex. So when we have a solution, have a strategy, you need to make sure that you control, and we have a regulatory firm, advisory firm we've hired for compliance, and they vet our materials, right, to make sure we're in the confines of our practice and operating principles. With regard to Chris's point on greenwashing, we believe we're at the apex of really describing a strategy that has solutions and framework. And so all the work we've done for the past few years on SDG alignment and output solutions, coupled with the world at night philosophy that Chris showed earlier, we need to back that up with our investment process and our portfolio holdings, and that's what we're doing. As far as the SEC, I do believe ESG is driven by investors, companies, private and public. I think the SEC regulatory framework is valid, but it's a sign of the increased interest in investments around ESG. It's not going to be a hurdle to growth and development. I think it could even be a catalyst.
Okay. Has COP26 caused you to reevaluate or change your strategies? And if so, how?
I want to let Bill run with that.
I've been doing clean tech for 18 plus years. And in my earlier days, I really thought by now we'd have a global binding carbon trading market globally. In my earlier days, I thought this is sort of a binary event given government regulation, and that's not the case, right? So depending on who you talk to, so I was not at COP, but I've talked to plenty of people that were there. It was either a success or a failure, depending on the business of the entity going in. But I think there's what was really called out is what I've mentioned throughout my presentation and Chris's presentation today is the gap between aspirational goals and action. That was called out. It was the first time that we've had governments targeting coal use. It was the first initial reference to fossil fuel, the first framework for carbon trading, the first focus on methane, which is 80 times more carbon intensive than CO2, the first structure around principled environmental mitigation using natural resources with forestation. And then we saw global actors like India call for net zero by 2050. So I think it was a success. It takes a while for governments to move. Governments are moving, companies are moving, capital markets are moving.
Chris?
So just very quickly, just one of the very visible things that came out for some people of COP was indigenous groups speaking to the role of colonial and colonization in getting us to where we are today in terms of the magnitude of the issues and problems. And going back to my earlier comment, based on that observation, we can do this indefinitely and just have an argument and be paralyzed and all dislike each other, or we can actually put one foot in front of the next and actually act on it. And that's again.
Sorry, Chris, your comment. One important nuance too is the need for those of us in developed markets to engage in a just transition. Maybe not to light up the rest of the world to the degree that we've lit up the Eastern Seaboard. And the just transition can be had in the clean energy transition.
Correct. No, absolutely. So to me, the point is actually take action in a positive step and in a creative way that's also recognizing where we are today in the world on all these different issues we're discussing.
I have one more question and then just a few concluding remarks. I think we're going to go over a minute or two. I hope our audience will accommodate us, but just letting you all know. This is a personal question to both of you. What are you passionate about beyond this conversation?
Bill, you go first and I'll jump in right after and we'll use time well too.
Terry, can you repeat that, beyond the conversation?
Beyond this conversation about ESG and investing and this whole world that we've been discussing, what are you passionate about beyond that? Beyond this conversation?
No, I think you picked up on it in my bio. So I love what we're doing here by investing in clean energy. So the reason why I'm doing this is aligning what I love to do. I love to be out in the environment. So when I'm not looking at screens and researching companies, I like to be outside in the environment, whether it's snowshoeing with the snow, hopefully we'll have for the next few decades, walking, hiking, cycling, skiing, doing it all outside because that's what I love to do. Gardening. I have a significant garden in my backyard where it's still actually a precursor to a warm fall here in Boston. We're still having production of our greens in our garden. So that's what I love to do. But I love to do clean energy investing. But when I'm not, I'm out in the environment. Yes, and engaging with other impact professionals here globally.
Yeah, thank you. And Chris?
Yeah, I've spent the last actually 2 decades or a little bit more in urban park restoration and reclamation. And why that matters to me, I started here in Houston with our version of Central Park. It's called Herman Park, but I've expanded that to really a national network of across every major U.S. Municipality. You see a reimagination of a specific area. It might be a lakefront, it might be a riverfront, it might be a former industrial site. And why these spaces matter to me and why I'm so passionate about them is they're really, in my opinion, the last vestiges we see of a civic forum where everybody comes together. It's free, it's small d democratic, and many of these areas also touch in the investment arena on what we now call opportunity zones. And cities who pay attention to why these spaces matter. An easy example that happens to be a personal friend is a guy, interestingly from Texas, who co-founded the High Line in New York. It sounds like a cannabis-infused amusement park ride, but the High Line was an abandoned railroad that's turned into effectively a city park. It's now the most visited site in Manhattan. It actually, they never thought it would happen this way, but it really was instrumental in rebuilding the entire west side of Manhattan. So these have huge economic repercussions, have huge influence on cities' identity and cities' ability to attract the intellectual capital, because so much of what Bill just touched on, if you look generationally, these are priorities of integrating fully one's professional and personal life. So for me, this has been a way to do that. How do we think about everything being connected in a way that's very thoughtful and that touches us very directly and something bigger than ourselves? So that's my passion.
Thank you. Chris and Bill.
And Terry, we just had a question from Paul about how do we hold our holdings accountable to these frameworks? And I just want to if 30 seconds.
Sure.
The point of the SDGs is to create this framework where we can hold the firms accountable. This lends itself to fundamental equity management, where we're out there meeting with these companies on a regular basis. So we have a framework that we are tracking for these companies to hold them accountable. There's also significant efforts on the part of regulators and asset owner agencies globally to hold these companies accountable. So there's something the acronyms go, it's a long list, but there are frameworks coming out of Europe, and these are global frameworks. And so we're all members as managers and asset owners to incorporate these principles to hold the companies liable.
Thank you. Thank you for answering that. Chris and Bill, I want to thank you for generously sharing your time and expertise to address these critical ESG investment and best practices for individuals and companies grappling with how to best manage their ESG investments and mandates and how to get started even. Your slides, along with the summary and a recording link to this webinar, will be posted on the LINKCO website. The recording will be posted on the LINKCO YouTube channel. And please note that the recording will be posted after it's been reviewed and approved by compliance. So that may take a couple days. Our next webinar is on Wednesday, January 12th, 2022, and it will spotlight LA County's Chief Sustainability Office initiatives through the lens of leadership and business opportunities with Dr. Rita Kampelef, who's the Sustainability Program Director of the Chief Sustainability Office. You can register via the LINKCO website and via our LinkedIn postings at the end of the webinar. There's in the chat box, you can also find the link. When we conclude, there's going to be a brief survey. Please take a minute to answer it. It helps us get better at what we do, and your feedback is valuable. LINKCO Executive Search provides elite companies with top C-suite and upper management nationwide using a proprietary step-by-step process for both clients and candidates. We are on 24/7, 365. When you need help, please call upon us. Thank you for joining and stay safe. Bye, everyone.
Thank you all.
Thank you.